Friday, November 15th, 2019. 1 week ago today, I was describing the rise in interest rates following the Fed's rate cut the week before. A new Friday, a new world. Rates are going back down. This is a little weird. The Fed controls the overnight cost of money. Long-term investors control long-term rates. Well, it's not unusual to have rates move in directions opposite the Fed. When the Fed cut at the end of October 30th, it made clear that that was the last cut that it had in mind based on current economic data. Bond traders are a gloomy bunch, and their working assumption is, well, if the Fed's not going lower, then it's probably going higher, and so I'm going to sell and rates are going up. So they did. Chair Powell this week, lost in all the other stuff that's going on in D.C., spoke to Congress, and he made it very, very clear that this mid-course correction, this cut 3 times from cost of money at 2.5 to 1.75, the odds are very heavy that they will not reverse any part of that. That it will take an earthquake for the Fed to begin to raise the cost of money again. Now, Powell very carefully said he makes no brief for the chance of a cut, but he went on at considerable length and, as decisively as any Fed chair can speak, said that he thought the risks of inflation were very nearly non-existent. He said we have no risk of inflation from an overheating economy, not from an unemployment rate that is too low, and if the risks of inflation aren't there, then we don't have a risk that the Fed is going to change, shift gears and go back up. What's the chance that we go down? The history of this Fed inflation thing goes back a long way. I can claim to have been present for a great deal of it. Engraved in the mind of every central banker in the world are the 1960s and 1970s, when, with the best of intentions, central bankers allowed inflation to ramp. In the United States, overall inflation in 1979 reached 18% per year. Inflation was running 1.5% per month. And so engraved in these economists is model making, which is all based on looking backwards at prior data, prior markets, prior tendencies. And it's almost impossible for them to sort out the last 20 years in which all of the inflation pressure has been down. And the result has been mistakes that central banks have made. The European Central Bank in 2008 and 2011, the Fed arguably last year, the Fed arguably in 2005 and 6, the Fed's efforts to preempt a return of the 1960s and 70s have been completely inappropriate to the world the way that it works today. Also involved in the reversal of interest rates to the downside rather than the upside. Trade issues. If a trade deal fails and we get a new spasm of tariffs, rates are going to go down, and so is the global economy. But that seems unlikely. The White House is preoccupied with other things. There's an election next year. It's not likely that a new branch of trade war will appear. But a deal isn't likely either. Both China and the White House expect the other to surrender, and in public. That's not going to happen. So we may get some little trade deal. So why the tilt today towards a slower global economy in the absence of inflation? 2 things. Global trade. Global trade is a leveler. Global trade tends to level wages everywhere, which means pulling down on U.S. wages as wages in trading partners increase. And also IT. I share with you a small IT experience of my own this week. I bought some socks for my wife, whose feet are always just frozen bricks all winter long. I bought them from Amazon, these great thick Canadian socks. They're too big. So to Amazon I went to get the return label, And instead of a return label, what I got was a QR code and instructions to take the socks to the Whole Foods that's closest to our house and give the socks to customer service and show them the QR code on an iPhone. Great. But consider the IT disruption and the deflationary forces involved in just that little change in pattern. Normally I would go to the packaging store. It's the easiest way to use a return label and get anything back to a mail order vendor. If Amazon's going to behave this way, the world's largest retailer, the future's not so bright for packaging stores. Nor is it so bright for FedEx and UPS, who one at a time carry a pair of socks back to an Amazon warehouse. There's no increased cost to us. In fact, I don't have to go to the packaging store, which saves time and money. All we do is, the next time we go to Whole Foods, and we're at whole paycheck every 2 or 3 days. Just bring the socks along. The customer service desk at any grocery store is only intermittently busy, so there's no incremental increase in cost inside Whole Foods, and the returns will accumulate at these customer service desks and be shipped in bulk, not one at a time, back to Amazon, which reduces Amazon's return cost. That kind of IT disruption is happening all around us, all day, every day, and it's reducing the rate of inflation. A highly technical report referred to in the copy usually beside this video at the Fed itself says that the Fed has underestimated those forces. The bottom line in the report is that the Fed's calibration of neutral, that is, what interest rate is neither so high that it slows the economy, nor so low that it tends to encourage inflation. The tendency at the Fed has been to think that that neutral rate is just a little bit above the inflation rate. The new paper at the Fed says it's at least a percentage point below the inflation rate, which says the Fed today, after 3 rate cuts, may be a whole percentage point too high. On that thought, have a good weekend. Good luck with your socks.